**2 days. That is all that stands between every paper promise on the COMEX and a moment of reckoning, one that most traders, most analysts, and most mainstream financial outlets are actively pretending does not exist. April 1st, first notice day, arrives in 48 hours. There are still 1,726 contracts sitting open. That translates to 8.6 million ounces of silver that somebody, somewhere, is expected to physically deliver from vaults that have been hemorrhaging metal for 5 straight months. And the coverage ratio propping up this entire structure right now? *13.4%. Let me repeat that number because your mind may have glossed right over it. *13.4%. That is not approaching stress territory. That is stress territory. That is past the threshold where this system is supposed to operate under normal conditions. If you have been following this channel, you already understand what that number implies. If you are new here, welcome to OG John AG. What you are about to hear over the next several minutes may permanently alter the way you view the silver market. Hit subscribe. Not as a favor to me, but because the data discussed on this channel simply does not get discussed anywhere else. And by the time you finish this video, you will understand exactly why. Silver closed today, March 30th, 2026, at $71.19 per ounce **. That is up $2.53 from yesterday's session and more than $37 higher than where it sat exactly 1 year ago. On the surface, that paints the picture of a healthy market. A metal responding to demand. A price tracking fundamentals. But the surface is where the cracks begin. And this is where today's breakdown becomes something profoundly different from anything you will hear on mainstream financial television. 3 weeks ago, silver was trading above $83, $83.48 on the 6th of March, to be exact. Then the bonds started falling. The United States and Israel launched coordinated strikes against Iran on February 28th. The supreme leader was killed. Missiles flew in both directions. The Strait of Hormuz, the choke point through which ** 20 million barrels of oil transit daily ** roughly 25% of all seaborne crude on the planet, was effectively shut down. Oil detonated past $100 a barrel. And silver, the metal that is supposed to surge during geopolitical upheaval, the metal marketed as the ultimate safe haven alongside gold, did the exact opposite. It collapsed. From $83 to $67. A ** 20% drawdown ** in a matter of days. In the middle of a shooting war. So if silver is supposed to be a crisis asset, and the world is quite literally engulfed in armed conflict right now, why did the price implode? Hold that question. Because the answer involves something most participants in this market are not emotionally prepared to hear. And it connects directly to every single data point I am about to lay in front of you. Let us begin with what is physically happening inside the COMEX warehouse system at this very moment, because this is where the real story lives. Registered silver **, the metal that is actually tagged, warranted, and available for delivery against futures contracts, has declined ** 11.9% in the last 30 days alone. **, that is ** 10.3 million ounces ** pulled from the vaults in a single month. The paper leverage ratio now sits at ** 7.5 to 1. ** For every single physical ounce of deliverable metal in those vaults, there are 7.5 ounces of paper claims stacked on top of it. At the current pace of withdrawals, registered silver would be ** completely exhausted in approximately 163 trading days. ** Not calendar days, * trading days. That clock is running right now as you listen to this. Pull up the CME delivery reports while this plays. Look at what happened in February. ** 5036 contracts * were physically delivered. That is ** 25.18 million ounces * of real silver walking out the door, the highest February delivery volume in modern COMEX history. And February is not even a major delivery month. January was more alarming. over ** 40 million ounces ** demanded for delivery in a month that traditionally generates barely 1 to 2 million ounces in delivery requests. That is not hedging. That is not speculation. That is a coordinated physical drawdown by entities who want metal, not paper, and who want it immediately. The March delivery data makes this picture even more severe. ** 10/5/26 contracts * stood for delivery this month. That translates to * 52.63 million ounces * of silver demanded against only * 86.13 million ounces * of registered inventory. Between February and March, in just 60 days, the COMEX has delivered * 86.4% of its entire registered stockpile. ***. Let that number sit for a moment. Absorb it. * 86.4% of a deliverable supply base, transferred out in 2 months. And March has not even finished settling. Think about what that means at an operational level. The exchange that is supposed to anchor global silver price discovery just watched nearly its entire deliverable supply walk out the door in 8 weeks, and it is still functioning as though nothing happened. Prices still move on the screen. Contracts still trade. Clearinghouses still process. But behind the screen, the vaults are hollowing out. And the entities taking delivery are not speculators looking to flip contracts for a quick profit. The data reveals industrial end users and institutional investors demanding physical metal * immediately * upon first notice day, not waiting, not rolling forward. In February alone, * 37.3% of total deliveries * occurred on the very first day. That is not patience. That is urgency. Now zoom out further. Since October 2025, total COMEX silver inventory has fallen from roughly * 532 million ounces to 366 million ounces ***, a * 31% decline in 5 months. ***, registered stocks have dropped below * 90 million ounces ***, a threshold that many institutional observers consider the bare minimum cushion required for a functioning delivery market. Open interest still hovers near * 230 million ounces. ***, that means for every ounce available for delivery, there are more than * 2.5 ounces of paper claim * sitting above it. And that is the * generous * calculation. Here is where it gets darker. Since the 2021 peak, registered inventory has collapsed by more than * 80%. From a system that is supposedly the backbone of global silver price discovery. What remains is roughly * 28 million ounces *, backing billions of dollars in paper contracts. The entire deliverable stockpile is worth approximately * 900 million at current prices. That is the total collateral underpinning a derivative structure measured in the * hundreds of billions. But COMEX is only one fragment of this picture. In a moment, I am going to walk you through what is unfolding in Shanghai. And when you see the spread between East and West, everything I just told you about COMEX will look like the calm before the real storm. Shanghai. The market that actually delivers metal. The market where factories, refiners, and industrial giants line up for real bars, not paper contracts that quietly settle in cash when physical delivery becomes inconvenient. While COMEX and LBMA futures are pricing silver in the $67 to $71 range, physical silver in Shanghai has been commanding prices ** well above $90 ***, and in some instances, far north of $100. The Shenzhen Shuaibei gold market, one of the largest physical precious metals exchanges in Asia, was recently quoting spot silver at ** $136.80 per ounce on the sell side ** and $91.60 on the buy side. ***, that is not a normal spread. That is a market screaming, in the most explicit terms possible, that the official price printed on Western exchanges has ** detached from physical reality. ** Shanghai Futures Exchange inventory tells an equally devastating story. From asterisk 559 tons in November 2025 down to 318.5 tons by February 2026 a 43% decline in 3 months. Combined with COMEX drawdowns, the two major exchange systems have shed approximately 161 million ounces over the past 6 years. And the metal that left did not migrate into some private vault, waiting to return when conditions change. It went into solar panels, into electronics, into electric vehicle components, into industrial applications where silver is consumed permanently and cannot be economically recovered. Now layer on what China did on January 1st, 2026 because this is where the structural picture shifts from concerning to genuinely alarming. Beijing added silver to its list of dual-use strategic materials. This was not a minor regulatory tweak. This was the identical playbook China deployed with gallium, germanium, and rare earths. The new export framework slashed outbound silver volumes by up to 40%. Only 44 firms have been authorized to export silver for the 2026 to 2027 period. Strict licensing, quota enforcement, and a minimum export price pegged to the Shanghai benchmark not the London or New York price. Consider what that means for Western supply chains. China controls somewhere between **60 and 70% of global refined silver output. When that pipeline gets choked, the rest of the world does not have a contingency plan. There is no second China. The existing global deficit, which already stood at approximately *2 500 tons per year before these restrictions, is now projected to widen beyond *5000 tons annually. India recognized the implications immediately. Delhi has fast-tracked free trade agreement negotiations with Peru and Chile both top silver-producing nations, specifically to lock in alternative supply corridors. That is a sovereign government treating silver access as a national security priority not an investment opportunity. And that deficit is not a recent development. It has been compounding for *5 consecutive years. In 2025, global silver demand reached an estimated *1.24 billion ounces. Total supply, including mine production and recycling, came in at only *1.01 billion ounces. A shortfall of *230 million ounces. Between 2021 and 2024 alone, the market absorbed *678 million ounces more silver than it produced. That is nearly *10 months of total global mine output consumed in excess of what was actually mined. And here is the dimension that makes this deficit nearly impossible to resolve quickly. Most silver is produced as a byproduct of copper, zinc, and lead mining. Even if the silver price doubles overnight, miners cannot simply scale up silver output because their entire operational model is structured around base metal economics. New mining projects take *8 to 12 years to develop. Ore grades are declining globally. There is no quick fix. There is no lever to pull. London is buckling under identical pressure. In October 2025, LBMA lease rate spiked to *34.9%, with intraday peaks reaching *39.2%. Normal lease rates sit below 1%. Even after the spike dissipated, rates have remained elevated around *7 to 8%, signaling persistent difficulty sourcing immediate physical silver within the interdealer network. London was unable to deliver 1,000 tons of silver to India in October. COMEX could not fulfill a massive delivery demand of 330 contracts submitted in a single block order. It took *10 hours of negotiation for the buyer to accept a cash settlement at a $65 million premium. The system did not deliver metal. It paid someone to go away. And that brings us back to the question I posed earlier. Why is silver crashing during a war? The answer is not complicated. But it is deeply uncomfortable for anyone currently holding the metal. Three forces are working against silver simultaneously. First, surging oil prices above $100 per barrel are siphoning safe haven capital that would normally rotate into precious metals. When energy costs spike this aggressively, institutional money chases oil exposure, not silver. Second, the US dollar index has strengthened sharply as the primary global safe haven vehicle, making dollar-denominated silver more expensive for international buyers and imposing a price ceiling. Third, massive institutional profit-taking following gold's 65% gain in 2025 and silver's 154% gain triggered a cascade of liquidation across futures markets. The Iran conflict itself accelerated every one of these dynamics. Gold hit an all-time high of $50.62 per ounce at the end of January, then cratered nearly 25% to a low of $4.100 before recovering to approximately $4.550 today. Silver mirrored the trajectory, spiking to $96.40 on the 2nd of March the day the strikes were confirmed, before collapsing back below $70 within weeks. The velocity of that reversal shook even experienced precious metals traders to their core. The gold-to-silver ratio has blown out from the low 40s in January to 65 today. That is a massive expansion in an extremely compressed time frame. When that ratio widens this quickly, it historically signals that silver is underperforming gold on a relative basis. And sharp expansions in the ratio have, almost without exception, been followed by violent reversals once fear subsides and industrial demand reasserts itself. The last time the ratio compressed from these levels, silver outperformed gold by multiples over the subsequent 12 months. Now, here is the bearish case. And I want to present it with full transparency because this channel does not exist to sell you a narrative. It exists to show you data. The bears will argue that silver's industrial demand, which accounts for roughly 60% of total consumption, is vulnerable to a global recession triggered by the energy shock. If oil sustains above $100 and the Strait of Hormuz remains closed for months, manufacturing decelerates. Solar panel installations get postponed. Electronics production contracts. Silver demand from its single largest consumption category could decline meaningfully. The Silver Institute's own forecast shows industrial fabrication potentially declining by *2% in 2026 due to thrifting and substitution in the photovoltaic sector. On top of that, ETF outflows have been significant. SLV has experienced $1.94 billion in net outflows over the past month and $2.44 billion over 3 months. PSLV is trading at a 3.43% discount to net asset value, suggesting retail appetite for physical exposure through trust vehicles has cooled. If the war ends quickly and oil prices normalize, the safe haven premium evaporates, and silver could retest the $60 level. That is the bear case. It is real. It is grounded in data. And it deserves your honest consideration. But here is what the bears consistently fail to account for. Physical silver does not care about futures prices. Industrial buyers do not stop needing silver because a ticker on the COMEX screen prints a lower number. Solar panel manufacturers in India and Southeast Asia are not cancelling orders because a paper contract in New York declined. The physical market and the paper market have fractured into what multiple analysts now describe as *3 separate islands. Asia centered on Shanghai. North America centered on COMEX. Europe centered on LBMA. Each with different prices. Each with different supply dynamics. Each with different levels of actual metal availability. Between 2016 and 2025, global banks, including JP Morgan, UBS, and HSBC paid over $1.2 billion in fines for spoofing-related manipulation of precious metals prices. Multiple traders were criminally convicted and sentenced. This is not conspiracy theory. It is documented legal record filed in federal courts, adjudicated by regulators, settled with admissions of wrongdoing. And the mechanisms that enabled that manipulation, the ability to flood futures markets with synthetic short positions to suppress prices while quietly accumulating physical metal on the opposite side of the trade, those mechanisms are still in place. They were not dismantled. They were fined. There is a profound difference. On a single recent trading day, 1.8 billion paper ounces were exchanged on Western exchanges. That is 2.25 years of total global mine production traded in a single session. Virtually unbacked. Settled by no one. The paper-to-physical ratio has reached as high as 356 to 1. 356 paper claims for every single physical ounce that could theoretically be delivered. The entire system functioned on one foundational assumption, that nobody would ask for delivery all at once. In early 2026, that assumption cracked. The SLV ETF sits at $64.30 today with a 52-week range stretching from $26.57 to $109.83. That range alone tells you everything about the volatility regime silver has entered. PSLV holds 214.7 million ounces of physical silver with a net asset value of $18.42 billion. Combined SLV assets stand at $46.2 billion. These are not fringe instruments. These are massive capital pools directly tethered to physical metal. And every ounce held inside those trusts is one fewer ounce available for industrial delivery. India imported over 700 tons of silver in October alone. Reports indicate that Delhi is moving to remonetize silver through its banking system beginning April 2026 potentially enabling over 250 million people to use silver as financial collateral. If that framework activates at scale, it would represent the single largest structural demand shock the silver market has experienced in modern history. And it would arrive against a backdrop where every major vault system on the planet is already operating at critically depleted levels. JP Morgan project silver averaging $81 per ounce in 2026. Citigroup forecasts $100 with a potential extension to $110 in the second half of the year. FX Empire analysts project silver breaking $120 and moving toward $150. The current price of $71 sits well below every single one of those institutional targets. Either the banks are collectively wrong, or the current price is a temporary dislocation manufactured by the exact forces I just outlined: war-driven liquidation, dollar strength, and paper market suppression that cannot hold against physical reality indefinitely. So here is the hypothesis. And I want you to weigh it against every data point I have walked you through today. If the Iran conflict reaches a ceasefire within the next 30 to 60 days if oil normalizes below $80, the dollar softens as rate cut expectations return, and the gold-to-silver ratio contracts back toward its historical norm of 50 to 1 silver does not merely recover to $83. It overshoots. violently. Because the physical deficit did not pause during the war. COMEX did not magically refill its vaults while bombs were falling. Shanghai did not suddenly receive a flood of new supply from mines that do not exist yet. China did not reverse its export controls because Western prices dipped. India did not stop importing. Every single structural pressure that drove silver above $90 in January is still in place, sitting beneath the surface, coiled and waiting. The war did not fix the shortage. The war just put silver on sale temporarily. And when that sale ends, the snapback will not be gentle. If you watched this entire breakdown, if you followed every data point from COMEX to Shanghai, from London to the Iran conflict, drop one phrase in the comments right now, OG John AG 2.0 not because I need validation, but because when someone scrolls through those comments 3 months from now and sees a wall of people who understood this data before the rest of the world caught up, that is the strongest signal this community can send. Share this with one person who holds silver and does not understand why the price dropped during a war. That single share could fundamentally change how they navigate the next 60 days. Invest with logic. Never with noise. OG out.